Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are going to look at financial reporting pre-mocks for June 2025 session, and we'll be doing section A right now. We know section A has 15 questions, each will be from different scenarios, any accounting standard throughout the syllabus. Each question is worth 2 marks. It's either you get 2 marks or you get a 0 in this. So there's no partial marking, and there could be true or false, there could be MCQs, all the different kind of questions will be here. But we expect not lot of lengthy calculations over here because we know it's only for 2 marks. So this is the basic introduction for section A. What we'll be using, just like always, we'll be sticking on to the CBE platform, plus maybe the on-screen calculator. Or I have my phone calculator with me. In your exams you'll be having your calculator in your hand, so you're free to use any of it. But yeah, we're not going to use any of the rough sheets or pen and paper for this. So you'll be seeing all my mind mapping and how we go about the calculation, how I do my rough calculation, all on the CBE platform. So let's get this started. We have question number 1 over here. Always begin with rating the requirement. In accordance with IAS 2 inventory, what should be the value of this machine in the inventory presented in Brighty Company's SOFP on 31st December X9? So year ending is 31st December X9. We'll see if this is complicated calculation, then we'll see whether we have to use the scratch pad or not. So year ending is 31st December X9, just keep that in mind, and we're talking about inventory. And we need some value of machine. Okay. At 31st December X9, Brighty Company has a bespoke machine in the inventory that was manufactured to cater one of their clients' unique needs. The original cost of the machine was 500,000. Okay, some numbers are coming up. We'll just write this. Question number 1. Original cost of the machine was 500,000. Then selling price of the machine has been agreed upon for 520,000. So sale price is 520,000. However, due to recent enactment of safety regulation, modification must be made to this machine at an additional cost of 80,000 before it can be sold. So you'll have minus 80,000. That's like a cost of sale. The client has agreed to pay 40%. Okay, so 80,000 full you don't have to spend. 40% client will be taking up of these additional modification cost by means to an increase in the selling price. That means 80,000 into 40 percentage client will take. So into 60% of this I will have to take. So how much will that be? 80,000 multiplied by zero point 0.6 will be equal to 48,000. So 48 from 525 minus out, that is equal to 472,000. Now cost is this much, sales price basically NRV is this much. That according to IAS2 we have to value the inventory at lower of cost in NRV. So this is a smaller value. So we have 472,000 over here, option number B. So that will be our answer. So this one is done. Next, using deferred income method of IAS 20, that is government grant, which two of the following show the values at which grant and asset will be presented in SOFP for year ending 30th June X4. Okay, this is the year ending. We're doing IAS 20. They want the value of the grant and the asset in SOFP. So what happens in the deferred income method? Asset will be at its original value, some depreciation will happen. Grant will be within the liability section and you will have to release it slowly. However, the depreciation is being done. Now, Alpha Company purchased a new machinery on 1st July X3. When is the year ending? 30th June X4. 1st July X3 to 30th June X4 means, okay, this is like 1 year cycle only. For 10 million with a useful life of 10 years. So, question number 2. Asset had initially a value of 10 million and 10-year life means 10 divided by 10 is equal to 1 million depreciation. So 10 minus 1 million is equal to 9 million carrying value. That was very straightforward because asset does not get affected by the grant based on how much grant you're getting. So that is sorted over here. 9 million carrying value will be there. The acquisition was partially funded by 3 million government grant on the same day. So if I get a 3 million grant, oh god, why is this not going away? Okay. So grant is equal to 3 million, and if I release it over 10 years, that will be equal to 0.3 million each year. That means within my non-current liability there's supposed to be 3 minus 0.3 million, that is equal to 2.7 million non-current liability. I will just keep this on hold. Let's see what are the options we have. We have non-current asset of 9 million, that does not show how much is the liability, so that anyways is out. Non-current asset of 7 million, that's also out. Okay, let's see, do we have liability in a separate one? Okay, non-current liability of 2.6 million and current liability of non-current liability and current liability. Okay, so non-current asset we have to choose one option. About liability we have to choose one option. So assets we have 9 million carrying value, so that anyways is this one. Now the other two options are talking about non-current and current liability as well. That means this 2.7 million non-current liability now to split between current and non-current. How do we do this? 2.7 million is the non-current liability at the year end. How much out of this will be released in the next 12 months? Again, a zero point 0.3 million will be released. So minus 0.3 million is equal to 2.4 million will be in non-current liability, and this 0.3 million will be in current liability. So 2.4 million in non-current liability and current liability worth 0.3 million. So this one is also our answer. So option B and C will be the solution for this one. Let's get going to the next one. What is the depreciation charge of locomotive engine in SOPL for year ended 31st December X3? Year ending is 31st December X3. They want the depreciation for engine in SOPL. Okay. Kentucky company purchased a locomotive train on 1st July X3. This is the story beginning. Year ending is 31st December X3, so that is like 6 months. July, August, September, October, November, December. Yeah, 6 months. Purchase price of the train was 975,000. Okay, so some number work is there. Question number 3. So purchase prices 975,000. The locomotive engine needs to be dismantled at the end of its useful life of 7 years. So dismantling cost we have to find present value at 1st July X3, that is the beginning date. Cost of dismantling are estimated to be 150,000 at the end of the life of the engine. So future value of dismantling cost is equal to 150,000. Okay. The components of train include the seats of the train, cost of dismantling. Okay, this was price, and locomotive engine needs to be dismantled. Okay, components of train include seat of the train, which comprises 15% of purchase price. Its exterior, that is 45% of the purchase price, and then locomotive engine. So we have to focus only on this locomotive engine over here because that was the question. Okay, and 40% of the purchase price, discount rate is 6%. Okay, so our focus is only on the locomotive engine. So let's extract information about this alone. First thing they told in the beginning line was locomotive engine needs to be dismantled. That means this future value of is basically for locomotive engine only. So we'll just, this is about locomotive engine. Future value is this much. We need to now find the present value. They told that the discount rate is 6%. So this one into 1 divided by 1.06. How many years later? Useful life is 7 years. So we have to do raised to 7. Now this I can't do on my normal calculator. So I'll need the uh, calculator from here. Let's do this. 150. First let's find out what is this discount factor. 1 divided by bracket 1.06 raised to 7 years. Syntax error. Okay, let's find out where is this. Let's try once again. Did this go away completely? How do I restart this thing? Clear. Okay. 1.06. Okay, what do we do? Not working. Okay, let's try. Okay, 1 divide. Okay, 1.06 raise 1.06 raised to 7. Okay, 1.50363. Okay, whatever that is. So let's keep it 1.503. Wait, do we have discount factor table here? Okay, we don't have that. Do we have it here? We don't have it. Okay, forget it. So let's try this once again. 1.503. And just note down over here 1.5036. I'll have to do this 1 divided by this one. So let's clear this entire thing. 1 divided by 1.5036, that is 0.66507. So I got the discount factor. Now that I have to multiply with this answer, multiply it with 150,000, so that is 99.7605. So we'll just keep it to 99.7605. Okay, we'll just keep it there. So now we got the present value part, that is fine. What else is there? The part of the purchase price. Locomotive engine, they told it's 40% of the purchase price. So purchase price is equal to 40 percentage of 975,000. That will be equal to 975,000 into 0.4. That is equal to 390,000. So my total value would be equal to 390,000 plus 99.7605. That's equal to 489.7605. Okay, now we got the asset value. Now what do we need? We need the depreciation charge. How much is the useful life? 7 years. So divided by 7. And how many months do we have till the year ending? We have 6 months. So into 6 by 12. So 489.7605 divided by 7 into 6 divided by 12. That is equal to 34.982. Okay, 983 basically. So that is equal to 34.983. We have an answer like that. Okay, 34.983. So that is our solution. Okay, so that is done. If in case any of you all know how to use that in-house calculator to get that discount factor fast, if in case you know some extra tricks or something, just do type down in the comments, because I couldn't get it right. So I had to follow a lengthy method. But anyways, yeah, we got to the solution. We spent some time here, so we need to catch up in the next questions. Let's go. What will be the fair value per car for daily company in accordance with IFRS 13? Okay. Daily company has a fleet of 40 identical cars for which the accountant wants to calculate the fair value. Daily company has the option to dispose the cars in the following markets. Okay. The markets are London, Birmingham, and Manchester. Sales price per vehicle in each of this market is 5,000, 3,500, 6,000. Looking at the sales price, Manchester is the one that's best one. So by default, if only these values were given, we would choose that, okay, that is the best value where we can get for the product. So we can choose that as the fair value. But according to IFRS 13, I have to look at the market where most amount of transaction is happening, where an active market is existing, where most amount of sales are happening, high volume of activity is happening. So that gives me more priority in choosing the fair value as per IFRS 13. So let's look at the different headings we have. Last year transactions of daily company in London and Manchester, you can see the values are only 10,000 and 28,000. Birmingham has 60,000. So this is where the highest volume of transaction is happening. Oh, this is last year transaction. total volume of transaction in the market. This is 400, this is 450, and this is 500. So again, giving a positive point for Birmingham, showing that that is the highest activity market. Transportation cost per vehicle is 100, 500, 350. So the lowest cost is also over here. Maybe because that is where the highest volume is happening. So maybe the unit cost is quite less. That could be the reason. Transaction cost per vehicle. Transaction cost could be based on different other factors, not exactly something to be capitalized or used in the fair value calculation. So this table you don't have to, this column you don't have to really bother. So forget that. So from the highest volume, we found that Birmingham is the place that we have to look out for. That is the principal market. So how much would be the fair value for the product? 3,500 and minus transportation cost per vehicle, that is 100. This is sales price. This is transportation cost. So it's like fair value minus cost of sale, that kind of a thing. So 3,500 minus 100 is 3,400. That will be option number B. So we're done. Next thing, let's go to, so the question, time we spent in the previous question where we got stuck with the present value calculation that we saved in the previous question because we didn't have to think a lot. So whenever you lose some time in one question, don't get panicked over there. Just keep in mind that that time you will save in some other small question which is going to come up. All right. Now, which two of the following factors could have led to this decrease? Okay. Operating profit margin of the Springs company has dropped from 20% from previous year to 16% in the current year. Now, this is question number 5. Now, the operating margin formula is PBIT by sales. If operating margin has to fall down, it's either because the PBIT has gone down or it is because sales have gone up. Now, when operating margin is going down, it's generally not a good indication, which means we're not talking about sales increasing over here. Probably it's because the PBIT is falling. Now, what is PBIT constituted with? Like, what leads to PBIT? The main thing that constitutes to PBIT is basically the operating expenses, like the impairment expense. Sometimes depreciation will be recorded there, marketing cost could be there, some any one off expenses will be there. Then if any inventory write off is happening, that will be there. Salary will be there, electricity bill, water bills, or transportation cost, distribution, packaging cost. All these operating expenses, when this goes out of control, is when operating margin starts to fall down. So you have to look out for indications within these over here. They're asking which two of the following could have led to this decrease. So try figuring out from this which could have led to your PBIT going down, or if maybe very rarely they might give an indication where sales are going up. So let's look at this. Number 1, Springs company debt financing provider increase the interest rate on the company's loan. Now, if interest rate is going up, what will cost on me? Finance cost. Now, finance cost is shown where in SOPL after PBIT. Now, after PBIT, finance cost goes up or goes down. It does not have an impact on my operating margin. So that going up will not exactly cause my operating margin to go down. So option A is wrong. Next one. After conducting a review of its tangible asset, Springs company decided to reduce the useful life of machinery and equipment. What happens when life is reduced? Let's consider an example. Let's say if I have an asset of 10 million and that is having 10-year life, what will be annual depreciation? 1 million. But what if I decide to reduce the life and make it to 5 years? What will be my annual depreciation? 2 million. So what has happened over here? When life goes down, depreciation goes up. Depreciation goes up means operating expense goes up. When operating expense goes up, PBIT will fall down, which means operating margin will fall down. So option B is one of your answer. Next one. Springs company was able to negotiate better deals and obtain price deductions on raw materials purchased from supplier. When price deductions are obtained on the raw materials, what would happen? Cost of sales will go down because purchase price is included within cost of sale. If cost of sale goes down, it is an expense going down, which means your overall margins are supposed to get better. That means this is not an indicator. This is something that's indicating your margins getting better. But again, when cost of sale goes down, the first thing that gets better over here is gross margin will get better, not exactly the operating margin. But yes, it has an impact over there as well. So that is also not an option. So by default, option D will be our answer because we had to choose two options. But let's read this one. Springs company increased the wages of its managerial staff in response to new governmental policies on minimum wage. So salary is one among the operating expense. Expense goes up, so PBIT goes down. So hence operating margin goes down. So we got our answers over here. Let's go to next one. Calculate the gain on investment to be recognized in Iringa company's statement of profit and loss on OCA for year ending 31st December X6. So we need to find the gain on investment for 31st December X6. So keep in mind of the year ending and what is the requirement gain on investment. Okay. On 1st April X5, this is 31st December X6. So 1st April X5, 30th March X6, 31st December X6. So this is like a 1.5-year timeline altogether. Ringer company made an investment in the ordinary shares of Brown company paying 10 million for the shares. This is question number 6. Okay. So they paid 10 million for shares. So this is a share investment for shares and additional 1 million in broker fees. 1 million broker fee. Okay. The shareholding was less than 2% of the ordinary share capital. So this is an IFRS 9 question. So what you have? You have an investment, financial asset into what? Into share. That means you have to now decide whether are you going to hold it in FEPL or FEOCI, then do the accounting on that basis. Iringa company made the irrevocable election to classify this investment as FVOCI as the recognition date. If in case they have not mentioned over here in the question this fair value through comprehensive income, but they've just mentioned over here, Iringa company made an irrevocable election to classify this investment or made made a decision at the inception to use alternate accounting treatment as per IFRS 9. All this is an indication that it's an FEOCI. So even if it's not given, just understand that whatever indications are given to you. So this is an FEOCI. As per FEOCI, on day one, we have to account it for fair value plus transaction cost. That means the day one value will be equal to 10 plus 1 million. That is equal to 11 million. So that is the opening figure. Now, as at 31st December X5, this was 1st April X5, 31st December X5, question was 31st December X6. Okay, 31st December X5 means like 1 year ago from the actual question requirement. Fair value of the investment was 12 million and it was correctly accounted also. So what we have to do as per FEOCI by day 365, that is the year ending, we have to shift it to the fair value which is 12 million. Then on 30th June X6, that is 6 months later, company sold the entire investment for a cash consideration of 13 million. So they sold this thing and the sale price was 13 million and the story got over. What are they asking? What is the gain on investment? For SOPL in year ending 31st December X6, keep in mind, don't go all the way from 11 million to 13 million and record 2 million gain over here because your financial year is 31st December, year ending is 31st December X6. So year beginning is 1st Jan X6. Now, whatever gain that was made from this 11 million to 12 million, that's 900,000 gain. 1.1, no, 11 million to 12 million is no, 1 million gain. Oh, yeah. 11 million to 12 million is 1 million gain. That 1 million gain will be recorded in SOPL in the previous year. That is 31st December X5. Once that year is over, SOPL begins from zero once again. So in this year, what happens? There is a carrying value of 12 million and you sold it for 13 million. 13 minus 12 is equal to 1 million gain is there. So what will be your gain? 1 million. Now don't record over here. Now we are very used to writing this thing like rounded off to thousands, so don't write over here 1000 because that looks like 1000 million. That will give you your wrong answer. If you're writing the full figure, let's say 1 million million, it is, that is also wrong. So keep in mind what is given in the box and what is given to the side. They've given million over here, so you need to write only one over there, so it shows that it's 1 million as your answer. So that is done with question number 6. Question number 7. What would be the finance cost in respect of the property lease in Highbridge SOPL for year ending 30th June X9 to the nearest dollar? To nearest dollar. Okay, so we'll have to write without decimals. This is a lease question, so IFRS 16 it is, and we have to tell about the finance cost. Okay. On 1st July X7, when was the year ending? 30th June X9. 1st July X7 to 30th June X8, 30th June X9. So this is like a 2-year timeline we have. And in the second year, they need what is the finance cost. Okay. So Highbridge acquired commercial property through a 10-year lease. Okay. Information below is relevant to this contract. On 1st July X7, an initial payment of 8 million was made. Okay. Annual lease payments of 16 million are due on 30th June each year in arrear. Okay, so lease rentals are paid at last 16 million. Implicit interest rate is 6%. Okay. So finance cost will be on 6% of whatever is the opening balance in that year. Then present value of lease payment on 1st July X7, that is at the beginning. Before that initial lease payment was 100 million. So we can do the calculation like this. Initially, that is on 1st July X7, 100 million was the liability. Okay. Now on day one itself, as per the first line, 1st July X7, on day one itself, you paid off 8 million. So 100 minus 8 million is equal to, you have 92 million liability pending with you. Next, what happens? That 92 million now is on day one itself. Okay. This 92 million will climb up by how much? 6%. Finance cost will add on that. So 92 million multiplied by 1.06. Oops. 92 million into 1.06. So it leads to 97.52 million closing. Now what happens at the end? You will pay the lease rental of first year, that is 16 million. That is over here. 16 million is paid. So 97.52 minus 16 million is equal to 81.52 million. Now this becomes the opening balance for the second year. What do we need in this question? We need the finance cost of the second year. How to calculate that? It will be whatever percentage is there on the opening balance. What is the opening balance? 81.52 million. What is the interest rate? 6%. So this answer multiplied by 6%, 0.06. That will be equal to 4.8912. Now that is the answer. So finance cost we got 4.8912. We need to write it to the nearest dollar. So I didn't take the full figure. So how will this be now? Is it 4,000 or 4 million it is? Okay, let's just brainstorm. This was millions, 16 million. So this is 81 million before the decimal. So this is supposed to be million. And since there's no more decimals after that too, I'm assuming it should be zero. So this I'll read it as 4,891,200. So that should be the nearest dollar. So that will be 4891200. 4891200. 4,891,200. 4,891,200. Okay, fine. So that is the answer for this question. Let's go to next one. What was the amount of cash consideration paid by Diamond Co for the investment in Sapphire Company? In cash consideration, so this should be something related to the consolidation topic. On 1st May 20x5, Diamond Company acquired 75%. Okay, this is consolidation. We might need some workings. So let's just take this up. Okay, they acquired the ordinary share capital through an initial cash payment and agreed to pay cash contingent consideration to the shareholders of Sapphire Company. So some cash consideration is there, which is what we have to find in the question. Let's keep it as X. Then some contingent consideration is there, and they didn't tell how much it is. Fair value of contingent consideration was assessed to be 350,000 by Diamond on this date. So we have the value 350,000. Then Diamond Company calculates the NCI using the fair value, which was estimated to be 150,000. Fair value of NCI is equal to 150,000. The goodwill arising on the date was calculated to be 400,000. So goodwill is equal to 400,000. So as per the format, we just need what is the fair value of net assets at date of acquisition. So we can find out how much it is. Okay. Following figures for Diamond Company are relevant. Ordinary shares were, share capital is 600,000. So that comes up here. Plus retained earnings on 1st Jan X5. When was the acquisition happening? 1st May X5. What do I need? I need the retained earnings at date of acquisition. What is given to me? Retained earnings on the year beginning. So from year beginning, if I want to reach to that particular date, what do I have to add over here or subtract over here? The profit or loss during that time frame. They're telling profit for the year ended 31st December X5 is 140,000. 350 is the beginning. If you add 140,000 profit to that opening figure, you will get the closing retained earnings. But I need the retained earnings somewhere over here on 1st May. So what I have to do, opening retained earnings plus profit for prorated for how much, what is Jan, Feb, March, April, for 4 months, profit for 4 months. So how much will that be? 350,000 is the opening retained earnings plus profit is 140,000 and I need that for 4 months into 4 by 12. This will give me the net asset figure. So let's calculate this. 140 multiplied by 4 divided by 12 equals to 46.6667 plus 350,000 opening retained earnings plus 600,000 share capital is equal to 996.67. 996.67. So we got the net asset value. So we have this one, this one, this one, this one. All we need is to get this cash consideration. So we can just reverse work it. What is the normal formula to get this goodwill? The purchase consideration plus fair value of NCI minus the fair value of net asset, we get the goodwill figure. So if I want to reverse work it, it will go like this. Goodwill figure plus fair value plus net asset figure minus the NCI figure minus the consideration. So I have to work it like this. That will be equal to 400,000 plus net asset is 996.67 minus NCI is 150,000 minus consideration is 350,000. That gives me the answer 896.67. So 896.67, we have the answer over here. That is option number D, and we got the answer over here. Let's go to next one. What should be the amount of warranty provision in Walker Company SOFP? Okay, this is about provision liability. Okay, on 30th June X5. Okay, warranty provision means this is related to IAS 37. Walker Company's year end is 30th June X5. Year ending. Okay. Walker Company provides a 1-year warranty with each product sold during the year. Past experience indicates that no repairs are required for 80% of the goods sold by them. On an average, 15% require a minor damage, minor repair, and remaining 5% require major repair. Okay. Company service manager has estimated that if minor repairs were required for all the product, the cost would be 120,000, and if major repairs were required, it would cost 1.2 million. So that's a very straightforward calculation. Whenever you have a repeated revision, like for repeating recurring events, you have to find the average of it based on the probability. So how much is the probability? First is you have a 15% chance. Okay, percentage doesn't work in this. So 0.15 multiplied by 120,000 is the cost, plus the other chance of happening is 0.05, 5% chance happening of 1.2 million. That is equal to 78,000. So that is option number A. So that was very quick. So we saved a lot of time over here. Let's go to next one. How will this change in accounting policy? This is probably IAS 8. Impact the financial statements of Gillard Company for year ending 30th June X2. Okay. Gillard Company applied the cost model for its investment property from many years. Investment property is IAS 40 and you were following cost model. Okay. Starting from 1st July X1. 1st July X1, 30th June X2. Okay, 1 year story this is. Company shifted to the fair value model for investment property. Okay, fine. Since fair values were higher than the carrying amount for all the investment property, a fair value gain of 40 million was recorded in financial statement. Okay. There is no change in the estimated useful life of the investment property. Okay. And they're asking how will this affect the financial statement? First, they're telling both the operating profit margin and the gearing will increase. Then both profit before tax and gearing will decrease. Profit before tax will increase. Profit before tax will stay the same. First, let's look at where does this gain go to? What is this related to? Investment property. So this gain is more like an investment income that we get. Where will investment income be shown? After PBIT, which means whether there is a gain in this or a loss in this, what would happen? this will not cause my PBIT to change, which means my operating profit margin will not have an impact over here. So first one is out anyways. Now let's look at second, third and fourth. Profit before tax will decrease, profit before tax will increase, profit before tax will stay the same, while gearing will go up. Now is this a gain? Yes. If gain is recorded, what will happen? Profit before tax will definitely go up because this is after PBIT, and if it's written over there, profit before tax will go up. So profit before tax going up is confirmed. So profit before tax will decrease, wrong. Profit before tax will stay the same, wrong. So by default, now option C is the only one remaining. So profit before tax will increase, that we understood. But let's just go on to explain why gearing will decrease. What is gearing formula? Debt by equity or debt by debt plus equity, any formula you use. Okay, we can explain this in two ways. First way is we can say this as question number 10. Gearing is equal to debt by equity. Okay. Now we told that profit before tax will increase because of the gain. When profit before tax goes up, profit after tax goes up. If profit after tax goes up, retained earnings within equity will go up. That means the overall equity figure goes up. When equity figure goes up, what would happen? When denominator goes up, the other one will go down. Meaning this is like inversely proportional. So if equity is going up, gearing will fall down. So this can be one explanation how we can say that gearing will decrease. Another explanation we can say is gearing has an alternate formula. Gearing is equal to debt by debt plus equity. Now, this debt by debt plus equity, the concept of debt plus equity can also be called as capital employed. Denominator only, okay? Debt plus equity can also be called as the capital employed. Capital employed now has an alternate formula which says about the non-current assets plus the current assets minus the current liability. Now don't focus on all these things. Just focus on the part of non-current asset. Okay. Now capital employed is non-current asset. One element of capital employed is non-current asset. So we can collectively say that one element within the denominator is actually the non-current assets from capital employed. Here what is happening? The carrying value, cost model is being changed to fair value model. So what is happening? There's a 40 million gain happening. Gain one entry went to SOPL. Credit gain went to SOPL. What about the debit entry? This will cause my investment properties values to go up. When this investment properties go up, NCA will go up. When NCA will go up, capital employed will go up. That means my denominator will go up, which means my gearing will fall down. In this way also we can explain how change in this cost model to fair value model leading to a fair value gain can help in decreasing the gearing. So hope either of this explanation, whichever seems more logical to you and followable to you, you can follow that. But hope how we reach to the answer is clear. If in case you don't know anything about the gearing, still fine, no problem. We found out the answer just because of the impact with profit before tax from these options. So anyways, that's done. Which of the following terms represent the entry price at which the entity would acquire the asset or incur the liability at current market price? One indication given over here is this is a current market price. Second indication is this is an entry price. Now this is a very theoretical question, and if you have read the theoretical topics for these accounting standards, it's a very straightforward thing. Current cost is the one that you will have to use like an entry price. Entry price means the price to buy something in today's market. You have an asset with you, and if you want to buy that same item in the market like a brand new item in the current market price, how much you will have to pay for it. This is called entry price, and that is basically the explanation of what current cost means. So that is very straightforward, nothing much to explain over there. If you know the definition, you will get understand what this means. In accordance with IAS 10 events after reporting period, which statement is correct regarding the dividends declared after reporting period? Okay, after year end is done, then they are declaring, but before the financial statements are approved for issue. That doesn't matter. They're declaring it after the year end, which means during the year end there is no existence of anything regarding that particular dividend. If in case declaring was made before year end and payment was made after year end, then we can say that okay, this is an adjusting event. Here declaring itself is happening post year end, and payment will happen someday after that, which means in the financial statements for that particular financial year you don't have to do any adjustments. So they're asking which one is correct in this. Okay, they should be recognized as a liability at reporting date. False. They should not be recognized as a liability at reporting date. Okay, seems fine. Let's see the remaining one. They should be considered as an adjustment to the post reporting date events. No, it's not an adjusting event. They should be recognized as an expense in SOPL. No, they just declared it and they didn't pay it, so it's not a expense. But again, dividend payment is not an expense either. It's something that you have to reduce from your retained earnings. So anyways, that statement is completely a wrong one. So option B is our correct answer. It should not be a liability, it's a non-adjusting event. You just have to mention it in the disclosure note. Then what is the diluted EPS of Charlotte Company at 31st December X5? So EPS is part of IAS 33. Charlotte Company has issued share capital of 5 million on 1st Jan X5. Year ending is 31st December X5. So we'll just use question number 13. Opening shares is equal to 5 million. Okay, at par value on 1st September X5, that means 30th August. So after 8 months, the company made a bonus issue of 2 new shares for every 5 shares in the company is having. Okay, profit after tax is 756,000. Okay, we'll just write that over here. Profit after tax is equal to 756,000, and company has a convertible loan note of 300,000 issued at a 5% interest rate. Okay, 300,000 5% interest rate. Okay, loans can be converted into 60 shares per every dollar 100 after 5 years. Something with bonus share also happened in between, and some convertible loan is also there. The tax rate is 30%. Okay, so first we have to find out what is the EPS calculation. That is equal to profit after tax by number of share. So first we need to find what happens with profit after tax, then we need to find what happens with shares also. So we have two parts to this calculation. First is this opening shares are there in the company at 5 million itself for 8 months. After that, what is happening? Some bonus shares are being issued. How much is the bonus share issue that is happening? 2 new shares for every 5 that is there in the company. So company already had 5 million shares. Or we'll just write over here. Use the calculator. Company already had 5 million shares, and for every 5 shares in the company, they are issuing 2 new bonus shares. That means 2 million shares are coming up extra now. Correct? For every 5 shares, 2 new shares. Correct only. For every 5 shares, 2 shares. 5 million divided by. Okay, correct only. So 2 million new shares are coming up, and so there's 7 million shares right now after 2 million shares being issued, and that is there for 4 months. That is till the year end. Now there is something called a bonus fraction that we have to take up in the share calculation whenever in the period before that bonus shares are issued. So over here, the people who were having 5 shares previously will now have 2 new extra share. That means every person that was holding 5 shares now will have 7 shares. So 7 by 5. This is how we get the bonus fraction. So in the opening part we will multiply this thing, then in the next part we have this thing. Then there is a convertible loan note that they are telling 300,000 is the value, and it is for every dollar 100 it can be converted to 60 shares. So that will be 300,000 divided by 100 multiplied by 60. That is equal to 180,000 shares. Okay, not 180,000. Let's remove this thing and try 300,000, and for every dollar 100 they can be converted to 60 shares. So it is 18,000 or 180,000. 180,000. So this will be equal to 180,000 shares in total. And how much will this be equal to? By logic, because this is a bonus fraction, at the end over here it's supposed to be 7 million still, but let's just confirm this thing once again. We have 5 million multiplied by a divided by 12 multiplied by 7 divided by 5, 4666666. Okay, fine. And how about the other one? I'll just write over here 46666. And how about this one? This will be 7 million into 4 divided by 12. That's 23333. So 4 plus 2 is 6. Then 3333 plus 6666, that will turn out to be 7 million, because I said this was a bonus fraction. So I mean bonus share issue. So anyways, it's more like being there in existence or not doesn't bring a great value in the profit figures. So this final thing is basically 7 million that will be there at the end of the year. That 7 million plus this convertible loan shares, how much it will convert to? 180,000. So the total shares that we will have in the denominator position will be 7 million plus 180,000. That is equal to 7,180,000, 7.18 million basically. Okay, so we got the denominator part. What happens with profit after tax? Initially it's at 756,000 itself. Now because there was a 300,000 loan in the company and now they are converting this into share, they won't have to pay interest on that anymore. How much will be the interest saving? Interest saving will be equal to 300,000 multiplied by 0.05, 5 percentage. 300,000 into 10% means 30,000, so 5% is 15,000. So 15,000 interest saving is there. But because of that, now you'll have to pay some extra tax because profit will increase, so you'll have to pay tax on that. How much? 30%. So how much extra tax you have to pay? You have to pay 30 percentage of that 15k. So 10 percentage of 15k is 1,500. So 30% is supposed to be 4,500. Let's just confirm. 15,000 multiplied by 0.3, 4,500. That is equal to negative 4,000, 4.5k. So what will be the total profit after tax? 750, 756,000 plus 15,000 minus 4.5 thousand. That's equal to 766.5 thousand. Now that is the profit after tax. What was the denominator? Denominator is 766.5, 766.5 divided by 7180, that is the shares, that is equal to 0.1067. You have any answer like that? 0.1067. When it gets rounded off, this will become 0.1067, 0.11. So that's supposed to be this answer. So 0.1, oops, 0.11 is our answer, and we have the solution for this one. Next, which of the following is correct regarding the factoring of trade receivables for year ended 30th December X3? Okay. On 1st December X3, year beginning, no, 30th December, 1st December, okay, 1 month before, Leslie company sold 2 million of their trade receivables to a Riley company. So this is the factor basically. So they are doing the factoring service and 2 million was receivable. The company received an immediate payment of 1.8 million. Okay. Under the factoring agreement, any receivables not collected after 6 months, like a bad debt, will be sold back to Leslie company. So this is like a recourse factoring. This will come back to us. What is the key idea for recourse factoring? Your receivables should not be derecognized. You have to keep it in the books until that last day. So whatever money comes up from the factor, how do you have to account for it? Debit, cash, credit, loan. You have to keep it like a liability, and only at the end, when things are sorted out, when you know how much bad debt is there or not, you have to do the further accounting part. So they're asking what is the correct accounting treatment for this thing. So we have to keep in mind of the recourse factoring accounting treatments. Number one, the 200,000 should be recorded as an administrative expense for the disposal of receivable. First thing, from the outside point of view, receivables have been disposed. From the accounting point of view, it's not disposed. Secondly, this 200,000 is not yet an expense. It might become or may not become an expense later on. So first one is out. Wrong. Receivables should be removed from SOFP and 200,000 should be recorded instead. False. That is for non-recourse factoring. So option B is out. C. Revenue of 1.8 million should be recognized for the year ending 31st December X3. Now, this is a cash that you got from the factor, not from the customer. When you made the sale to the customer itself, you would have recorded that 2 million sales. That's how receivables come up, because you must have recorded the calculation over there. Debit receivables 2 million, credit revenue 2 million. That means revenue recognition is already over if the work is completed. All that you have to see is how to account for this 1.8 million. So that is not a revenue. We mentioned the entry already, that was debit cash, credit loan, liability. So option C is also out. So by default, option D becomes your answer. The receipt of 1.8 million should be treated like a loan. So that is over. Moving to the final question from section A, which two of the following conditions allow a company to be exempt from consolidation according to IFRS 3? Ultimate parent produces financial statements available for public use that comply with IFRS. Okay, when the ultimate parent, okay, it's like parent of a parent, that ultimate parent, if in case they're producing a financial statements for public use, which is in accordance with IFRS, then the next middle parent can be exempt from producing a consolidated statement. True. Subsidiary trades in a distant foreign country and prepares accounts in a foreign currency. That doesn't matter when you're preparing in a foreign currency. When you make, consolidated financial statement, that foreign currency FS is supposed to be translated to this parent companies or whatever is the currency they follow, and then make a consolidated statement according to that. So that is out. See, company is a wholly owned subsidiary of another entity, and its other owners do not object to the parent not presenting consolidated financial statement. Subsidiary is there, parent is there, and they are wholly owned subsidiary by another parent. So the owners of this ultimate parent company do not object, meaning they do not have a problem if this middle parent does not prepare a consolidation of this parent and the subsidiary over here. This owner does not have a problem with it. In such a case, again, they can be exempt. They do not have to make a financial statement, consolidated one. So that is out. I mean, that is correct. So that is selected over here. Its business nature is different from that of the parent and the rest of the group. That doesn't matter. Whatever is the activity or whatever things you're involved in, you have to still produce a consolidated financial statement. So you can't be exempt because of this reason. So with that, we are done with question number 15, and that was the end to section A of this particular question paper. So hope you have followed with the discussion and hope this was helpful in answering the questions, and hope you have understood the meanings behind everything. And just like every other YouTuber will say, do make sure to share, subscribe, like, comment, whatever is there, and see you in the next video. Bye bye.